navigate the application called My Forex Book, My Forex Book or My Forex Factory. These two sites, one is a site, one of course offers a software application where you tend to track these macroeconomic events that happen. These macroeconomic events that tend to bring about volatility, that tend to cause chaos, and for some opportunity in the market. NFP, if you could recall, I told you is a high impact macroeconomic event that normally holds every first Friday of every month. First Friday of every month. So if we are in February, the NFP print that would be released on the first week of the NFP print that would be printed on the first week of February would be that of January. So if we're in March, the NFP print that would be printed would be that of February. Now, a peculiar thing happened on Friday. Mala Ahmed, you're just joining. I'll give us a quick recap. You have been a perpetual attender, so I'll give you that grace. I'll just throw in a quick recap. The topic for today, Mala Ahmed, is market structure, price action. And there are several disparities among strategies in the Forex industry, in the trading industry. You'd hear people calling themselves smart money traders, retail traders, Falcon, price action traders, Blassie. One thing is constant amongst all these strategies, and that is the ability to read market structure, the ability to understand price action. It doesn't matter what type of human being you are, whether you're black, white, Caucasian, green, purple, you eat food. You eat food. Same applies in the trading world. Regardless of the strategy you use, you need an in-depth understanding of market structure, price action. Of course, there are indicators that could help you read market structure, but those indicators, like every other thing in life, have their own disadvantages. And I, of one, don't use indicators. I use what we call naked chart analysis. Naked chart analysis. Naked chart analysis, of course, as the word implies, you look at the chart naked, the way it is. You don't add any noise to. Of course, for those of you here that are newbies, for the females here, you might not have an idea what an indicator is, but I think I should do that. I should open up a page and show you how a chart. Oh God, let me do that now. It's chaotic. It's usually chaotic. It's just so much. As far as I'm concerned, personally, of course, there are people that do use indicators. Certain hedge funds, people on Wall Street use indicators. But ultimately, it all comes down and boils down to find out what works for you and use it. Now, before I widen this image, you can already see how a chart that has indicators looks like. It's just so much noise. And if you can see, just take a look at this before it loads up. Just look at this. Just look at these lines. Just look at this. Of course, there are certain indicators that don't necessarily choke up your chart and make it look all noisy. But personally, I don't use any. So these are examples of how a chart that has indicators look like. Now contrast that with this. Look at this. Just a line and boom. You contrast that with this. You can literally look at the chart and read what it's saying and react and take advantage of any opportunity that might present itself. So yeah, that shall be our topic for today. But before then, I'll quickly talk about, oh my God, I didn't plug my battery. All right. Before then, I think today's session would be an hour-long session. We spoke with the PM and he told me to make it a bit less time-consuming, because humans, our attention span, especially millennials today, our attention span is just terrible. So we want to keep it really short but impactful. All right. Now, a peculiar thing happened on Friday. We had NFP on Friday, and we have unemployment report, unemployment rate. I really don't know what it's definitely unemployment. I don't know if the right phrase is unemployment rate or unemployment. Let's leave it at unemployment rate. Now, both these two macroeconomic events are high impact macroeconomic events. Please take note, high impact. Now, whenever a high impact macroeconomic event is released, it tends to spur up volatility in the market. It tends to either complement the current market structure or create some form of disarray and confusion and distort everything within a few minutes or seconds rather. But then after which, of course, market regains its original intended direction and move. So the peculiar thing that happened on Friday was NFP had a positive print. And NFP, of course, seeks to measure the number of jobs, excluding the informal sector. I think it's the farm. I really don't know. I've forgotten. That's a nitty-gritty that you guys can look up into later. But yeah, it seeks to keep track of jobs created in the United States over a month period. Guys, if the United States was able to create 100 jobs last month, but it lost 500 jobs. The first figure represents the NFP. Very quickly, the first figure represents NFP. So the United States had 100, let's say 100 new jobs created. Employment rate. Let's call it UR. In the month of just a minute, guys, just a minute. I want to do something. All right. 200. I want to cite an example. Unemployment rate. 500. Now, let's say when February NFP print was published, meaning when the January figure was published in February, the NFP print was, let's say, positive, all right? The United States was able to produce 100 jobs against the previous month, which was, let's say, 50 jobs. So definitely in the month of January, that was printed in February, the first week of February, the United States had a positive NFP print. Now, we're just citing an example here, guys, a case study. February NFP print, January NFP print that was printed in February. Remember, every first month of every month, the month preceding the month is being released. So if we want to release the figure for January, we print it in February, first week of February. If you want to print the figures of February, we print it in the first week of March. So January, February, March. If we want to print that of March, we print it in the first week of April, and so on and so forth. Now let's say this is the figure of January that was printed in February. Now this is the figure of February that was printed in March, meaning this month. Of course, it was supposed to be printed, I think, the first week of March, but it was postponed, if you guys could remember. For whichever reason, I didn't look into the reason. But yeah. Now, what happened was, let me choose a single person to unmute his mic. Let me choose a single person to unmute his mic. Let's do this together. I want to know you guys, if you guys are following. Let me see. Whom will I? Madam Muhammad Lawal. Machido, unmute your mic. Machido, unmute your mic, please. Machido.
Yes, sir. Yes.
Yeah. I will ask you a question.
Okay.
Can you hear me?
Yes, loud and clear.
Now, all right. NFP print of January that was printed in February was 100. Okay? It was
Yes.
100.
Yes.
NFP print February. Just a minute. Just let me finish. NFP print of February that was printed in March was 200. But now, the first question is, if NFP print of February of January was 100, that of February 200, how can we classify the NFT print of February? Is it positive or negative?
Come again, sir.
If the NFT print of January was 100,
Yes. Yes.
and the NFT print of February was 200, how can we classify the NFT print of February? Is it positive or negative?
It's positive, sir, because it is higher than that of the previous month.
Perfect. So if the NFP print is positive, that means DXY, any instrument that has DXY as the base currency is supposed to go up. Okay? And
Yes.
any instrument that has DXY as the code currency is supposed to go down. Now, what I want you to understand is why I classified this last week's NFP print as a peculiar one is because another high impact news was also released at the same. Could you please mute your mic? Just mute your mic. If I want you to speak, I'll ask you to unmute. All right. Now, why I classified the NFP print of Friday as a peculiar one was because two high impact news were released at the same time. When one was saying positive, the other one was saying negative. So if you had used the first one that was saying positive to make your trading decision, you would get burnt. So once NFP print is positive, I just buy USD JPY, anything with USD at the front, I buy. But what happened was there was also another high impact news associated with employment. Now, make no mistake, both of these two are related to employment. Both of these two are related to employment. Both of these two. Now, this isn't relevant for you for now, but I just want to cover it for now because I might forget, and this is just something that you might just jot down and have it at the back of your mind. When the right time comes, you will remember and you will know how to utilize this information. The first advice, of course, is whenever you see a high impact news, stay away. That's the best advice. If you're a stubborn person, then this is what I have to say for you, at least, and not yet, so to speak. Now, both of these two macroeconomic events are all associated with employment. Now, the NFP print suggested we had more jobs, but the unemployment rate suggested we had also lost more jobs. Okay? Now, assuming you have two local governments, in the first local government, you were able to get 200 people jobs. Woo! Congratulations. In the second local government, 500 people lost their jobs. As a governor of that state, that's terrible for you. While the first local government might be celebrating, overall the state is in trouble. Okay? So what happened in the United States was the NFP print was positive. They had created new jobs. Excellent. But overall, they had also lost more jobs in that same period. So definitely for that month, the United States economy would be in red. So it would definitely be a negative for the DXY, for the dollar. I hope you guys are following. Okay? In your first local government A, you created new 200 jobs for your people. Fantastic. In local government B, as a governor, 500 people lost their jobs within the same period. Now that's terrible. While local government A might be celebrating you, overall your state is in trouble employment wise. So the kicker here is NFP printed positive, but overall the employment rate was negative because despite despite the fact that 200 jobs were created over the month period, 500 jobs were also lost. So that's definitely negative overall for the US economy. So are you guys following? Does it make sense? Does it make sense? All right, perfect. So whenever a news related to the USD, United States, gets printed, high impact news, whenever it's positive, the dollar goes up. Any instrument that has the dollar at the front, let me not say base and quote because some of you are. So any instrument that has the dollar at the front, USD, and then any other thing besides it, it will go up. And any other instrument that has some other currency or instrument as base as the first instrument, and the USD as the second or code currency, that thing will go down. So overall, on Friday, employment wise, the US state suffered. So that's why gold and GBP USD and all those foreign currencies, foreign asset class instruments, whatever you want to call them, they spiked up, and then the USD based instrument went down. So that was what happened. Why? Why? I sent you a video where the chairman of the Federal Reserve, Powell, was arguing with with a lady from the Senate committee. I really don't know how the government system of the United States works, but The basic premise is this. He argued they want to increase interest rates. I explained what interest rate is the other time. It's simply another fancy term for usury. So I give you credit, but I charge you for the credit. I give you a loan, I charge you for the loan. You pay extra commission for the loan. So the United States said it was going to increase its interest rates. Therefore, that would result, I did tell you, that would result in many layoffs. Many companies wouldn't be able to pay off those loans because the loans are expensive. So if they were to pay only a few percentage, let's say I give you 100,000 and I ask you to pay me 110,000. And now all of a sudden I'm saying pay me back 130,000. That this is perhaps a silly example, but you get the gist. So as a result, people will lose their jobs because people that do collect loans wouldn't be able to pay off for those loans. So in order to compensate for the high interest rates, they will lay off some of their workforce. Mr. Kabir, we're really sorry. We have to let you go because the cost that we can't really afford to have you here. So please, Malama, Binta, please, before you know it, that was how the unemployment rate increased. That was how people lost their jobs, despite the fact that new jobs were created. So when the interest rates were increased, people, companies, several other people had witnessed layoffs in their organizations. Now, why did the United States increase its interest rates? Inflation was getting out of hand. Why? Inflation, there are so many things that do cause inflation, but one of the things that economics do argue is when there's so much money in circulation, inflation tends to happen. Inflation is simply when your money no longer have the same purchasing power it has. So you used to use 1,000 naira to eat, to transport yourself, to do so many things, but now 1,000 naira could barely feed you, let alone transport you to your workplace and to and fro. Okay, so in order to combat inflation, they increased interest rates because if they increase interest rates, people will lose their jobs. And if people lose their jobs, money would no longer be circulating as it used to because people are not working. People are jobless. And if you're jobless, you are not expected to make money. So money would reduce. And how would they be able to track that? Well, the first effect that that would have is unemployment rate would increase. And the way to confirm that the strategy has in fact paid off is when the CPI gets printed next week. CPI is simply it is also a high impact macroeconomic event that consumer consumer price index. Consumer consumer price index. Now, behind all of these, there's the dollar domination, the so-called dollar domination. Um, of course, the BRICS are fighting against consumer. The BRICS are fighting against the dollar domination. So this CPI is in fact a monumental CPI. It's going to be a very, very important CPI because it's going to mean so many things for the dollar. The so-called mighty dollar we know might no longer be relevant if the CPI indicates a certain result. And the so-called dollar we know as the mighty dollar might regain and continue its dominance all over, according depending on the result we see the CPI um, gets published, or you get the gist. So yeah, CPI is just another fancy term for is a macroeconomic event that seeks to track consumer spending. Okay, consumer spending, because if people have money, You see, the United States, I know as a Nigerian, you guys might be wondering, like, how the hell would the government know that we have money? Yeah, every single thing there almost tracked. Your flight, your normal grocery shoppings, every single thing. So you pay tax for anything, chocolates, biscuits, anything you do. So they know how much their population are spending. They know whatever their population are doing with money. So they know they can track that. Now, if the CPI gets printed as lesser spendings have occurred over this month, then the whole point of fighting inflation is a successful strategy. But if the CPI gets printed as, let's say, the same as the previous month or even higher, then it's game over for them. They're fucked up because many people have lost their jobs and they haven't achieved the so-called inflation measure, fighting inflation measure, which is another term for deflation. Now, all of these might sound gibberish to you, but there are those of you that would understand it now, but there are those of you that it would open a door of conversation, a door of research, a door of inquiry. And that's really my aim, to spark up curiosity, to spark up, to give you a head start, to give you an introductory foundation, so to speak. So, yeah, these things are really simple. And yeah, I think I should go to market structure. But this is just, by the way, this isn't the topic for the day. All right. Now the topic for today is, so you could communicate price images in the economy as a god of inflation. Yeah. Yeah, perfect. So um please, I'm really sorry if you guys are already bored. I know these things to bore people. Let's get down to the regular business. Let's get down to the regular business. All right. Um, the topic for today is market structure, price action. We have once spoken about market structure, but today it's going to be in a more advanced fashion. It's going to be in a more advanced fashion. Perhaps the next time we also speak about it again, it will get even more advanced. Market structure. Oh God. All right. Market structure, naked price action, naked chart analysis. Now, I will ask someone to unmute his mic and I will ask him a question. Let's see. Benedicta, please unmute your mic. Benedicta, go ahead and unmute your mic. Let's talk. Benedicta, if you're there, please unmute your mic. Thank you. Oh, okay. Wait, should I go? You need me to open the chat again. Oh God. All right. Now let's use this chart. Let's say this is gold. Okay, this is gold. So when the NFP print was published, gold spiked up. Boom. It spiked up and broke the previous highs that I really didn't think it would break, but it broke them. As for DXY, it went down. If I open my trading view now, honestly, this system, it would exhaust my charge. My battery would literally run down. But um, you can go to your trading view or MetaTrader, go to daily time frame, go to Friday, draw vertical lines, and you'll be able to, or just go to my FX book, look at the time the NFP print was published, go to your charts, identify that time, and look at the impact. Something like this. So of course, this is price. Here we have price. Here we have time. So go to on Friday. Look for Friday. If you look for Friday, then you draw a vertical line like this. Friday, Friday. So over the course of Friday, look at the time that the NFP was printed, and go to your chart. Look at what price did when the NFP print was published. So that's the way to do it. I hope that answers your question. So Benedicta, please unmute your mic. Come on, save us our time. Benedicta, unmute your mic. Let's save it, please. Benedicta. Goodness God. Benedicta, if you're there, please unmute your mic. Can you hear me? Can you hear me? Benedicta.
Yes. Are you getting me? Because I'm get to that thing. I can hear you. I can hear you.
Okay, let's save time. I need to get all advanced. We have spoken about it. So please, what are the types of
Are you
market?
getting me?
Yes, I am getting you.
Mm-hmm.
What are the types of market structure we have? What are the types of market structure we have? What are the types?
It's not connected. Are you getting me?
Ammar, please unmute your mic. Mala Ammar Al Hassan, please unmute your mic. Mala Ammar Al Hassan, please unmute your mic. Please tell me the types of market structure we have. Please, what are the types of market structure we have?
Coach, are you getting me now? I don't know. The network here is bad. Hello? Why is this saying one?
Yeah, tell me.
Coach, are you getting me?
Yes, I can
Okay,
hear you. What are the types of market?
we have the bullish and bearish, then ranging market structure. No. I'm not seeing the next year.
No. Close the first network participating. Thank you. Close the first network participating.
Let's please disconnect so I can hear them. Okay, sorry. I'm not hearing anything. I'm disconnect.
Please, who can answer this question? One person, please.
Okay.
All right. Please, Salan Sani, Ahmadu, what are the types of market structure we have?
Okay, sir. So we have ranging markets and we have trending market and we have trading market. I think these are the three types of market.
Yeah, perfect. Perfect. All right, perfect. We have the trending market structure. We have the ranging market structure. I deliberately outlined 4 to confuse you. Yeah. The ranging is the same as choppy. Listen, every single thing you do, I told you there are several discrepancies in the industry, people, several strategies. One thing is constant, and that is market structure. Regardless of what you do, market structure is market structure. You have to understand market structure. Whichever strategy you have to understand market structure as the backbone of what or whichever strategy it is you have. So you need to understand that whenever you open your chart, try to ask yourself, is the market trending or is the market ranging? What is the market doing? Is it trending? Is it ranging? All right, it's trending. Perfect. Where is it trending? Is it trending upwards or downwards? Perfect. Let's say it's trending downwards. What is the high time frame? Now, this is where order flow comes in. Time frame. I'm helping you understand how to build up a narrative, so to speak. Time frame, we have, of course, higher time frame, and we have lower time frame. So, you need to ask yourself, what is the order flow? What is the order flow of price? Slash order flow. Since when you look at your chart, whatever it is you see are simply orders. Orders are what moves the market, liquidity, so to speak. But for now, let's leave it at orders. You need to ask yourself, one, you need to understand that there are things we call time frames. If you could remember, I used the Russian dolls analogy the other time. They are big and small, but ultimately they are all the same thing. Ultimately, they're all the same thing. Now, if you want to build up a narrative and actually know what the order flow is in the real sense, you start with the higher time frame. I'll show you how to navigate. Will come a day I will use my phone to hold a session and I'll show you how to navigate both MetaTrader and TradingView using my phone. You have to know how to switch through time frames. Look at the market structure from a higher time frame. The higher time frame could range from, if depending on the type of trader you are, or whichever trader you are, it's really okay for you to. It's advisable, as far as I'm concerned, to have an awareness of what the market range from every corner. I think that would give you a better edge of high time frame could start from the monthly, weekly, daily. Let's see, for the lower time frame, the lower time frame could start from, let's see, 1 hour. We can classify 1 hour as the medium time frame, but let's leave it at 1 hour, 30 minutes, 10 minutes, 5 minutes, 1 minute, seconds. Have the seconds. if this is a chart, if this is a chart and you're using the daily time frame, what it means is each candlestick you see represents a day. So today, if this is Monday, this candlestick represents what happened today on Monday. If tomorrow is Tuesday, this here represents what happens throughout tomorrow. Tuesday. Same Wednesday, Thursday, Friday. So whichever time frame you're using, each candlestick you see on the chart represents the time frame you're using. If you come back to the monthly, what it means is each candlestick you see represents a month. So this is January, February, March, April, hence, and so on and so forth. If you come back to the daily, it's the same. If you come back to 4 hour, each candlestick you see represents 4 hour. Now, there's something we call fractal price action. Fractal. What fractal is saying is, of course, going back to the Russian dolls example, what the big and the small are all the same things, just at different sizes. So how fractal applies to market structure is, if the higher time frame is a trending market structure, let's say this is daily. So you see candlesticks making impulse, correction, impulse, correction, impulse, correction, impulse. If you come down to lower time frame, you might see something like this.
I do.
And so on, and so, and so on and so forth. Now, the importance of having a higher time frame perspective is when you come down to lower time frame, whatever you see will not move you because you already know what the higher time frame is saying. You've already identified higher time frame structures. So if the market is trending upwards on the higher time frame, even if you come back to a lower time frame and you see the market going in a downtrend fashion, you know that it's only a correction. So what you do is you come to your high time frame structural points. You mark out your structural points. Now those structural points are what we call POIs. They normally have what we call POIs around them. Could be an order block, could be support and resistance, could be an FVG, could be whatever. To then signal to price it's time to go back to the what high time frame trend. So with these noises you're seeing here, this on a high time frame is just a correction. But on a lower time frame, it will come across to you like a perfect trend. So you'd be thinking the market is on a downtrend, but ultimately it's in an uptrend. So if the correction is likely to give you only 50 pips, if you are patient enough to wait for price to make the correction and come to your higher time frame structural point or POI before you enter, within a few minutes you'd find yourself catching 100 pips, 200 pips. That's if the instrument, of course, is a very volatile one, just like gold. So joining the trend when trading gold or US 30 or any other instrument that is highly volatile, the risk is very less and the returns are astronomical. Absolutely mind-blowing. Let me repeat myself. The higher time frame market structure might be bullish, but if you come down to lower time frame, price would appear to you like it is bearish. When in fact, on a high time frame, price is only making a correction to then mitigate or reach a certain higher time frame structural point which could be an order block, a support, a resistance. This here, let's say, is an order block, FVG. When we get there, you guys will understand. But you need to know that market structure is of two types, either trending or ranging. Now, trending is the most advisable time to trade when you ascertain that the market structure is a trending one, whether it be upwards or downwards. Most preferably, try to know what the higher time frame market structure is, and then utilize time frames and order flow to enter your trades. Of course, taking advantage of the fractal nature of price, doing what we call a top-down analysis, starting from the higher time frame to lower time frame. On the higher time frame is where you conduct your naked chart analysis. And the lower time frame is where you execute. So all in all, they call that top-down analysis. Putting together high time frame narrative plus the lower time frame narrative to make a perfect trading decision. Guys, I promise you all of these things are very simple. Don't let me overwhelm you. Don't feel discouraged. Give it a few months of practice, of personal research, personal studies. Listen, by this time last year, I had no, I don't even know what is PIP. I don't even know that there's something called PIPs. By this time last year, I did not even know that I would become a trader. I did not. I had no idea. Today, I'm holding a session with 35 people listening to me making noise. So, if you feel overwhelmed or you just honestly at your own cost, I swear to God, trading can change your life forever. You'll never be the same person. You'll never be the same person. Unemployment rate is ravaging us as Nigerians. Making money in the permissionless space is not negotiable as far as I'm concerned. Because this is a permissionless space. No one needs to give you permission to make money from the market. No one. All you do is just analyze. Now that the market is closing, if you trade the London and New York session, tomorrow morning, you wake up. If you do utilize the concept of time and price, you know your times, you wake up, you look for certain opportunities, and you take them. Perfect. So if you want to give up because you feel it's difficult, that's your own cup of tea. But by the time the boot camp is over, bye-bye. 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 Don't even think about calling me because I won't pick up. To be very honest, I won't. This is just the spoiler alert. Honestly, I won't. All right. So, yeah. Price action is then ultimately whatever you see on the chart. Aside from market structure, there are other underlying concepts to then put together when understanding price action. Because if price moves in either a trending fashion or a ranging fashion, the question you then need to ask is context. Why would price decide to move in a trending fashion? Why would price decide to consolidate and move in a choppy fashion? Well, the same way you as a human being, you have a routine, you eat, you work, you rest, you eat, you work, you rest, you eat, you work. Isn't that what you do? You eat, you work, you rest. You eat, you work, you rest. That's it. Any other thing, any other human activity could be found in between these three. Any other human activity. Same way, price also has that nature. Rest, eat, work. Rest, eat, work. Rest, eat, work. Now, especially if you're trading the USD paired assets instrument. Let me call them that. There's a concept we call AMD, accumulation, manipulation. I think this week would be sticking with market structure. So I'll be going deeper and deeper and deeper on market structure this week, God willing. Accumulation, manipulation, distribution. Now, at whichever time, price is definitely either doing in a accumulation phase or manipulation phase or a distribution phase at any given time. At any given time, price is either in an accumulation phase or a manipulation phase or a distribution phase. And I'll show you just a minute. Of course, keeping in mind price action is two types, efficient and inefficient. Now, market structure is what you see on the chart. Price action is what is happening on the chart. Okay? Market structure is what you see on the chart. Price action is what is happening on the chart. The rationale behind what is happening. That's price action. Price in action. Market structure is just what is the chart like? What is it saying? What is it? What is the chart? What is the nature of the chart? Price action is the nature of the chart itself. So we either have an efficient price action or an inefficient price action. When the chart is trending and we see it moving like this, buy, sell, buy, sell, buy, sell, buy, sell, we tend to see that price action is efficient. When price action is making huge impulse, and then little correction, huge impulse, and little, we tend to say such price action is inefficient. And whenever price action is inefficient, you should anticipate it would get rebalanced because inefficiency is imbalance. Therefore, like every other thing in life, whichever thing is imbalanced, it will attempt or seek to rebalance itself. If you raise your left foot, we expect you to raise your right foot. If you raise your left foot, we expect you to raise your right foot. So if you raise your right foot overly spread out, that's an imbalanced gate for a person to work with. So we definitely expect you to raise your right foot to compensate for normal human movement. So left foot, right foot, left foot, right foot, left foot, right foot, left foot. But when we see you do a right foot, then you just make small correction and left foot, right foot. Yeah, there's problem. There's problem. So we expect such price action to get corrected sooner or later. I'll show you that on the chart. Now here, this is an efficient price action because we have buy, sell, buy, sell, buy, sell. Perfect. But this is an inefficient price action. Just look at this impulse. So ultimately, we will expect price to get rebalanced. Okay, and price here, if you can see, price did get rebalanced here. Okay, let me admit someone wants permission. And as you can see, price did get rebalanced here. Here, it got rebalanced because when this impulse was made, price did rebalance this impulse to then correct it because we have to get a buy when we have a sell. We have to get a sell when we have a buy. That's the only way to say price is being. I promise myself to be on this recording, inshallah. 5 months, I'll be earning this. Bro, I'm I'm not even trading a live account now. Trust me, I'm not even trading. But I'm just trading a live account. I'm not trading a live account. I'm actually trading an FTMO account. I'm not trading a live account. And because once the boot camp is over, I will focus on myself. That's when I'll start trading. Oh my god, this mouse was wrong. So yeah, it's really not about the money. Once the skill is there, inshallah, the money will print itself. So I used before starting trading me at time, no issues with that. So yeah, that's the price of being on serious. Don't think I should get it. What's wrong with this one? So back to what I was saying. Now, at any given time, price is either in either of these three phases. Either price is accumulating, or price is in a manipulation phase, or a distribution phase. I'll show you on the chart. So the question you need to ask is when does price normally accumulate? Well, when there's little to no volatility in the market, price usually accumulates. It fails to have a clear direction, clear trending direction. So it moves in a range. It makes what we call equal high and equal low. Now, when price seeks to break out of that range, we call that manipulation. After price broke out, of course, why is it manipulation? Well, manipulation is 419. Oh, when you are deceiving someone, you are committing a manipulation. So when price makes a manipulation like this, it would give you the impression that it wants to continue going down, but then boom, it will go back up. So that's a distribution. So I'll repeat, accumulation, thereby making a range, and then suddenly making a manipulation, breaking out of that range, giving us an impression that it wants to continue going downwards, then boom, it goes upwards. Distribution. So this is D, this is M, and this is A. We call it the power of three. The power of three elements to a trade setup. Look at this. Accumulation, equal high, equal low, and then suddenly we had a manipulation that broke out of the range, and then suddenly we had a distribution. Can you see? And then boom, price is back to accumulating again. Same cycle over and over and over and over and over. I hope it's making sense now, guys. All right. I hope it's making sense. I hope it's making sense. Should I repeat myself? Let me do it again.
Yes, sir.
At any given time, it is. Is it? Is it making sense? All right. All right. Now, at any given time, prices in either of these phases, either prices accumulating, ranging, moving within a range, or prices trying to make a manipulation to give us false signal, manipulation to deceive us, or price is in a phase to distribute. So, of course, the concept of order flow would come back again because buying and selling is simply orders. So you buy, you sell, order, buy, sell, order, buy, sell, order. Now, price needs to gather up orders, gather up liquidity before it's able to move. So if you want to go to Lagos to purchase whatever it is you want to purchase, you need to make sure that you have enough orders to then fuel your journey to Lagos to buy whatever it is you want to buy. If there are no orders, why would you go to Lagos? If there's no money to go to Lagos, why would you go to Lagos trying to go and buy anything? So of course you need to make sure you gather up enough orders. Is there anyone that wants to buy? Okay, I have enough money. Do we have money? Okay, you've gathered up orders. All right. then okay, I will go today. I'm actually going next tomorrow. Then I'm gone. Same applies here. So price would seek to gather up orders, take out those orders, then make the intended move. This is just the basic context, what type of English is this? Consider this just an intro. So the next question you need to ask is, what time do these phases normally happen? Well, normally at the opening session of Asia, okay, price USD pairs tend to accumulate. Normally during kill zones, opening of London session, we tend to have a manipulation. We call it Judah swing. Normally, before the kill zone finishes, market for that day tends to reveal its true intended direction. Which then brings us to certain concepts. BOS, touch, impulse, retracement, / correction, reversal, continuation.